Good morning and welcome to our quarterly Atlas Merchant Capital Worth quarterly economic update call. We're one wheel short, but we replaced it with an even more interesting wheel. Larry Cantor, our Professor Larry Cantor, who's the economist that Bob has worked with, Bob Diamond has worked with now for many, many years, decades in fact, is putting him on sabbatical this quarter because he's busy teaching a class, and so we gave him the day off, but not the quarter. Bob Diamond, one of the co-founders, we're here with David Shamus, the other co-founder of Atlas Merchant Capital, coming up now on 10 years, I believe. You're celebrating a 10-year anniversary soon?
We are.
Congratulations. That's a milestone, especially in your crazy business. Now, Bob, you and Larry have been gracing us with your presence the last couple of few years with your predictions, your insights, your anticipations about what's going to go on in the larger macroeconomic environment. Lots of that conversation centered around the Fed and what it would do, what it was doing, and what it was anticipated to do. You both were prescient in forecasting that the Fed wouldn't do anything most of this year. And then on our last quarterly call, you were both quite certain that it was time for the Fed to act now. There was some question as to whether or not it would be a 25 basis point or a 50 basis point increase in the rates. Indeed, we know it's now 50. Would you, Bob, tell us what you think that the implications of that are? Are you comfortable with the Fed's timing on this? And what are the implications in the near term in terms of fiscal policy?
Directionally, we're pretty much in line with where the Fed is. You know, the U.S. economy still is operating at pretty solid levels, from the labor market to inflation coming back in line to, 2 to 3% growth as we look out. I think in many ways it's the envy of the world, given the challenges that all economies, but particularly the U.S. economy, faced going into COVID. So I think on balance, we feel pretty good. We think the Fed probably would have been better off with 25 basis points. We worry that the signaling of 50, and let's be serious, 5.25, 5.5 doesn't make a big difference in terms of the economy or running businesses. So I think it was a little bit of a signal that has thrown the markets off. And my sense is that as you look forward in the market's expectation for continued rate cuts, the markets are well ahead of where the Fed should be. And Jimmy, you and I have talked about this quite a bit. I think the single biggest risk for the Fed is that they ease too quickly. They reignite inflation so that it becomes an issue. And then they're forced to pause, or even worse, to raise rates. So I think they need to be very thoughtful here, very data dependent. I guess the second thing I would say is, again, if we go before 2008, and with the great financial crisis, we all recognize we had a long period of zero interest rates over a decade and very easy money. From 2008 to the beginning of this rate increase by the Fed funds averaged about 1%, slightly below 1%. Prior to that, for 3 decades, Fed funds had averaged just over 4%. So I think being at 5%, 5.25%, 4.5% is far more normal for the economy. And I think we should expect a easier Fed going forward. But if we do see significant rate cuts, it's probably a function of a slowing economy. And that's something none of us want. So in terms of expectations, I'm modest in terms of further increases over the next 3 to 6 months. I think another 1 or 2 25 basis points is all I would factor in at this point, and then really watch the data on the U.S. economy and inflation.
So we have a normalized rate of just over 4% for 30 years, 3 decades. And then in the last 15 years, we've had an abnormal circumstance with rates hovering near 1%. You're suggesting then from your comments that they're trying to ease us back into the more new normal range, which will be closer to the 4 and change than the 1.
Exactly right.
I also think, Jim, I also think it's interesting, you got to remember the Fed has a dual mandate, managing inflation and managing labor markets. And I think that the fact that they went with 50 versus 25 in this round shows that in that balance, they seem to be more worried about labor and the general economy than they are about inflation, which is quite a change from the last 2 to 3 years.
Well, in the last 5 of these sessions, these quarterly sessions, I've brought up near the end to both you and Larry, Bob, and now to the two of you, David and Bob, the two economies that we see in this country. And more we're hearing echoes from everyone else that there really is two Americas. I think more, but certainly two working Americas. One is the people who are highly paid and doing well. And then there's the other half plus. Now that number seems to be moving from 44% to 50% to 63%, I heard yesterday, of people who are paycheck to paycheck. And they seem to be hit the most. But as we see gas prices in recent days and weeks moderate, that's the quickest relief for those people. As we see food costs moderate, or at least the increases moderate, that it impacts those people right away. The thing that concerns me, and I ask you, David, what implications might there be from this port strike, which is going to hit us on the grocery store shelves very quickly?
Yeah, look, to me, it's a question of how long it lasts. And sitting here today, it's hard to predict that. It seems like if this is a blip, if this is a few days or a week and it gets solved, there'll probably be no impact. I think if it goes long, the impact's going to be meaningful. And as you say, food, but any goods that come into our ports, which is a lot of goods, we're going to see higher costs on. And sort of weirdly, it might be a bit of a preview of what tariffs will look like if and when we have them in the next administration.
What I was excited about in terms of today's session that we're here for is being able to draw on the two of you, because in my circles, there's lots of conversation about private equity, VCs, venture capitalists, and private equities, and two very different things. In years gone by, they might have blurred a bit. And in fact, the capital markets might have traded into the VC world themselves at one point back in the 20 years ago or so. But we all look and say, okay, my business or a business I'm interested in or a public company I track, if it was owned by a private equity firm, how would it behave differently? I know lots of people are using ChatGPT kinds of LLMs to ask those questions, to feed in data so that we're looking at that. So the whole vernacular around private equity and how they approach things differently has become part of our business model now. And here we have two experts on private equity. Bob, you bring not only your 10 years of direct private equity investing and operating experience, but you bring your experience as a global banker, a global investment banker, a leader of one of Europe's largest money center bank in Barclays for all that time. You've had experience in living and working in Europe, of course, in North America, Asia, Africa. David, you've been a private equity guy since you left the Solomon program back some years ago. And so you've specialized in financial services. That's what Atlas Merchant Capital does. I wonder, as you look at through your lens of private equity experts, how might the economy continue to benefit from this robust private equity infrastructure that we have now, this megalopolis of different kinds of private equity? Here you're a mid-market private equity firm specializing in financial services. And you tell us a little bit about the kinds of activities that you deploy your capital in through Atlas Merchant Capital today.
Who should go first?
Well,
let me start with you, David.
All right. The leader chose you, David.
Oh, okay. So look, I would say there are two questions you put in there. Generally speaking, the changes, more private equity investments in the world and less public companies. I'm biased. I've been doing this a long time, but I would say that every CEO I know wants to be the CEO of a public company, except for every CEO of a public company. meaning, once you become the CEO of a public company, you realize often how short-term those markets are and how you're managing for quarterly earnings. And generally speaking, that's not necessarily the right thing for companies. And I think under private equity ownership, which is sometimes a little antithetical to what the public thinks, private equity ownership versus being public ownership, the companies get to think a little more long-term. Usually private equities or investors are focused on 5 to 7 years. And that's a lot different than worrying about the next quarterly earnings. And many times over the years in companies that we've owned, we have been willing to sacrifice near-term earnings and near-term returns for the expectation of longer-term benefits. I think it's a big issue. Layer on top of that additional costs over the last 20 years that's been laid on public companies.
Compliance costs, governance costs.
Compliance, exactly. It makes it very harder to be a public company.
Especially in the banking world, where you two are used to dealing in very regulated environments. It's something you're comfortable with. It's also a core competency because not everybody can. And certainly the banking sectors are super regulated. And that's why you have a distinct advantage having specialized like you do as a firm. So Bob, I wonder, you've on this broadcast before have talked about a new direction, a new thesis that you've developed over the last year or two at Atlas about the community banks and regional banks. David just mentioned how there are so many fewer public companies. I think in the last 20 years, the number of public companies has halved. The number of banks that you tell us, Bob, in the last call, you told us there's about 4,200 community and regional banks. That used to be 6,000 not too long ago. What's the trend? What's going on there? Tell us both your thesis on why regional and community banks, why are they important to us, and why are they become the centerpiece of your newest thesis?
It's a great question, Jimmy. And I think if you look at the 10 years of Atlas Merchant Capital, our thesis from the beginning was with the higher capital levels generated from the great financial crisis in 2008, that there were going to be many opportunities to invest in financial services away from deposit-taking institutions. I think with SVB in March of 2021 or 2022, I can't remember the years now, with the SVB collapse, I guess it was 2023 actually.
23.
With the SVB collapse, everything changed. I think the opportunity now for private capital to be deployed in regional and community banks is the single best opportunity we're seeing. So we're working on a number of investments right now into banks that we think will be real winners in that below 50 billion range. Why would we be investing? We'd be investing to shore up the capital, whether it's around the interest rate portfolio or the commercial real estate portfolio. But more than that, we would be investing to help provide support, both capital and advice and counsel on the opportunity to consolidate and for the stronger banks to acquire so many of the more private, smaller community banks, which today, given the regulatory reaction, are frankly too small to succeed. They don't have any view toward having 10% plus type returns. Much of that is generated, Jimmy, by just what you said, which is the greater regulatory intrusion, the focus on technology that's necessary to be developed around deposits, as we saw in SVB, regulatory reaction. So if you can imagine a strong regional bank acquiring a smaller community bank, those costs of regulation go away right away because they're duplicated. The larger bank already probably has much of that in place.
But don't you need to keep a balance, because it can't only be the 4 big U.S. money center banks? You've talked on this program before about how important these regional and community banks are to the economic fabric of this country. And if you have consolidation in those smaller and community-facing banks, does that defeat the purpose? But you're saying it has to happen because knowing your customer, the KYC costs, the technology costs, whether you're a $50 billion bank or a $250 billion bank, you have the same technology costs. And now the cyber risks are only increasing. And now they all have to embrace AI quickly to take out the duplication excess costs that we all have. And that requires capital. And for the first time now, these banks used to come together without outside capital. And now you're suggesting it really can't happen without outside capital.
Well, I'd start, even more basic than that, Jimmy. We are a small firm at Atlas Merchant Capital. We don't have as our banker B of A or Wells Fargo or Citi or JP Morgan. The truth is they're not focused on servicing a small business like us. One of the banks that was recently taken over was our institution. It was very focused on
First
small,
Republic?
medium-sized businesses, exactly. And the service level, we're multi-currency, we're multi-country, we're very, very low risk, but we need immediate reaction to currency trades and our investors moving money around the close of certain transactions. And the service level, not just for Atlas Merchant Capital, but for small businesses and medium-sized businesses throughout the U.S., that service level has been incredibly important to the growth of the economy. And one of the great attributes of the U.S. economy, and the reason it's looked so good in the last couple of years relative to Europe, is the diversity and the incredible development of financial services in the U.S., whether it's hedge funds and private equity funds and venture funds, but it's also institutions, the regional banks and the community banks that are willing to provide the service that small entrepreneurial family-owned businesses need. So we think this is incredibly important to the economy. And then if I change tact, what does the Federal Reserve, what does the Treasury want to see? They do not want to see all of these banks acquired by the big four. We've already seen concentration since 2008 in the larger banks increase significantly. So the Fed is very clear they're looking for private capital, international capital to come in and to support the regional and community banks. And our view is that this is going to be the most interesting investing opportunity in financial services, period, not just in the US, but around the world over the next 2 to 3 years. And we also think, and here you go, unsurprisingly, that Bob Diamond, David Seamus, and Atlas Merchant Capital is probably perfectly placed to work with those banks, both in terms of raising the equity necessary for shoring up capital and positioning themselves for what is an incredible go-forward opportunity for banks. We have higher rates. They're coming down a bit. And we have loan demand that we haven't seen in years. So it's a perfect environment for a healthy bank right here. We're very, very excited about this opportunity.
Yeah, and
Well,
Jim,
doing business, David, in a highly regulated environment is something that's important to have knowledge and experience with. And you, David, historically you did a major bank in Japan, Shinsei, which was a very complicated bank in a most highly regulated environment, and you did it very, very successfully. How does that experience bear out here?
Look, I would say, to your point, Bob and I have been dealing with regulated institutions our whole careers. And I find that it is something that you have to manage. There's lots of regulatory disclosures that you need to make that a lot of people in private equity aren't comfortable with. But we have more than crossed that Rubicon. And we think that gives us an advantage versus the many other people out there who are not willing to do that. There are many people I've met over the years in private equity that will say they do everything other than financials and utilities. And why is that? Because those are the two most regulated industries. Also, to come back to a point, Jim, just to put a point on why we're talking about banks right now, particularly around acquisitions when one bank's buying another. For many years, pretty much my entire career, when one bank bought another and did it in a stock-for-stock deal, they didn't need capital to do that. So the question is, why do they need capital now to do that? What has changed?
What's different? Yeah.
Yeah, and the answer is interest rates have gone up a lot in a relatively short period of time. Bob talked about how SVB changed all this. What happened at SVB and what happened in First Republic, as I think most people know, interest rates went up a lot in a short period of time. Those banks had a lot of fixed rate assets on their books. When everyone knows when interest rates go up, fixed income assets go down.
They were victims of their own success, David, because they had all this inflow of capital, and they didn't have a book to put it out in terms of loan instruments, so they bought treasuries.
They bought treasuries, and in First Republic's point, they originated a whole bunch of fixed rate mortgages for 30 years.
Yep.
So when you have a 2.75% mortgage on your book, and you're backing that with a 5% deposit, that is not a sustainable business, to state the obvious.
Yep.
Anyway, why are we talking about this? The way the regulations work is as long as there's no credit problem, you don't have to write that down if you're a bank just because interest rates have moved. Except, there's one big except here. When one bank buys another, the target has to do what's known as purchase accounting, and that pushes down even to the regulatory accounts. So two banks, both with a lot of fixed rate assets in their books, interest rates are up. The bank A buys bank B, they have to mark that interest rate exposure on bank B's balance sheet. So all of a sudden, these two banks that were fine from a regulatory point of view, you put them together, there's a capital need. So you might say, well, that means there'll be less bank M&A. There might be, but there still needs to be a lot of bank M&A for all the reasons we talked about. And that bank M&A that'll happen will require more capital these days than it ever did over the years.
So that's the difference, why they could be capital light in the past when they're doing a merger, because they could do stock mergers. Now, because of the mark-to-market requirements in a changing interest rate environments, they need capital to buttress the balance sheets.
Correct. And look, I've been in this business for 30 years, up until...
You started when you were 5 years old?
Exactly. Up until a few years ago, it's been, not 30 years, 25 years. It's been mostly a, lowering rate environment.
Yep.
Now it's an increasing rate environment, and none of us have seen it. For the record, it'll be 30 years next summer. But I rounded down.
So tell us about, how did your Japanese bank experience play out here? What was that experience like?
So look, the Japanese bank experience, which there's also been banks like this in the U.S., that wasn't a situation where we were trying to prop up a bank to keep them alive from not falling off a cliff. That bank had fallen off a cliff. That bank was, like many in the U.S. over the years, that bank was nationalized by the Japanese government. And now the government was looking for a way to on-sell the bank and put it back into private hands. I actually give the Japanese government a lot of credit for doing that. A lot of governments aren't nearly as anxious or willing to re-privatize these things. As we know, it's a different version of this, but the UK still holds big stakes in UK banks right now since the financial crisis. So the Japanese government was eager to re-privatize it. And they also understood that the only way that was going to happen was by giving the buyer some guarantees. And again, that is not unlike many deals that were done in the United States, particularly in the late 80s and early 90s, and then a small handful around the financial crisis. So as the buyer group, we got some significant guarantees on the assets for a 3-year period. That was enough time for us to figure out what the good assets were, what the bad assets were, sort that out. And by the end of 3 years, we had a viable bank that didn't need any government assistance.
What happens in this environment? So your focus is on regional community banks, U.S. Would you look outside the U.S.?
We certainly would, but our focus right now is really the U.S. for all the reasons we're talking about.
Yep.
I think there are 4,500 banks in the U.S. As we talked about, they need to merge. There's not nearly that opportunity to merge banks in other countries.
But you have a big investment in investment banking, middle market investment banking in Europe with Panmure. How's that going, Bob?
Well, thank you for asking. We just completed a merger between Panmure Gordon and Libero. Each of those institutions was somewhere around 5th or 6th in the market, middle market advisory and equity. The leader, Numis, was acquired by Deutsche Bank, and they've lost a lot of the people. A big bank buying a middle market company didn't make a lot of sense. So we vaulted to top of the league table, and we couldn't be happier with that merger. We think the go forward opportunity for advisory and equity for middle market companies in the UK economy is doing much better. It has a very positive momentum with the new government. We feel great. But Jimmy, in addition, we love this space, middle market. We think the service from an investment banking point of view is as important as kind of commercial banking for middle market companies. So the investment in Cascadia, Seattle and Austin based, number 2 non-bank owned M&A firm for family owned businesses, doing really, really well, acquiring talent, bringing in new clients. Marshberry, Cleveland-based, #1 M&A for the insurance brokerage industry, with John Wilper and his team have done there over the last 3 years since we made that investment has been extraordinary. They've most recently made their third acquisition, this one in the UK. So this whole space, Jimmy, of advisory services and equity services for middle market and family-owned businesses, both in the US and Europe, is something that's very attractive to us at Atlas Merchant Capital.
Let's turn to the impact of AI very briefly here as we wind up, fellas. I'm a fan of Seth Godin, and he wrote last week that if you're a worker in a job, if you're not looking to see how AI can automate as many functions of your job as you can, then you're in trouble because your boss is going to do that for you. And if you are doing it, great, because then that frees you up to do things that AI technologies can't do, which leaves you valuable to the enterprise. I thought that was a great way to look at, we should all be doing this. It's coming, whether we do it or it's done to us. And then I spent some time with Shelley Palmer, who I think is one of the great visionaries around technology and all things change and change through technology. And we had a great conversation the other day, and he got me all jazzed up about how AI is now dramatically impacting all of the aspects of a life. And then just yesterday, Bob, I was on a call with our friend Gavin Baker, who runs a treatise, and I thought I had a really robust and positive point of view in terms of how AI is impacting us. And I realized after a 90-minute call with Gavin and a team at a treatise that I got to put a 10x on that. How do you see that impacting the world of private equity, guys? How does this really rush to get the infrastructure in place, to get the energy that's needed, to get the chip design, and then to AI-ify each of our businesses? What's that going to do to the businesses that you're invested in that middle market, in your private equity portfolios?
You want me to take that?
Yeah, I think that's a good one for you, David. Mr. Technology.
Jim, you hear me?
Yep.
Yeah. Look, I would say, as Bob knows, there's no bigger tech geek around than me. Jim, if you saw my basement one day, you would believe me. But to me,
I like your new phone.
Yeah, there you go. Exactly. To me, AI is just another euphemism for more computing power. And I would say there are two things that the world has gotten wrong over the years. One is that technology is going to displace employees, and unemployment's going to go up. You know, I always say to people, you know, when the automobile displaced horses, people said, what's going to happen to all the blacksmiths of the world? Turns out, blacksmiths found other things to do, and unemployment stayed low. And here we are today, and AI is just more computing power. It's, again, to me, those two things are one and the same. And the other thing people have gotten wrong is every time they predict that computing power or technological advances have plateaued, things like the AI revolution or the internet revolution or mobile phones or whatever have come and shown them to be completely wrong. So all we're seeing here is just that continuing increase in computing power and usefulness. And I think we will not be seeing a serious increase in unemployment. And you said it very well, Jim, that labor will be repurposed in more efficient ways. I think that'll happen everywhere in the economy, and that'll push down into our little companies and our investments in things. And everything we do, we will find more ways to be efficient. We were talking earlier about the regulatory burdens of banks and the technology burdens of banks. I think more computing power will allow the technology costs hopefully to go down over time of these banks and to operate more efficiently, just like it will for lots of companies. So I'm very bullish. Again, everyone loves the term AI. I just think of it as more computing power. And 20 years from now, there'll be some new term that'll mean even more computing power, or whatever, probably less than 20 years. But I think it'll make everyone more efficient. That's a great thing, and more productive.
And I think that shines a light on why you're an attractive beacon for companies. In this case, we talked a lot about banks, but you're not just in banking, but everything in the financial services world, because they need a trusted guy who understands the technology, understands how to bring the collective resources to the table for them to learn, effectively deploy, and take advantage of technology early in the process. So to the founders of Atlas Merchant Capital, David Shamus, Bob Diamond, thanks for sharing your insights this morning in terms of where the business environment is going, where the economic environment is going. I think we limped through even without Professor Cantor, and I so appreciate your time and sharing your thoughts with our audience.
Thanks, Jimmy.
Thanks, Jim.
All right.
Here you go, Jim.
Good job as always.
This is the phone.
Our new spokesmodel for Samsung.
Foldable phone. Can't go back once you try
That's
it.
my Apple, just to balance it.
Thanks, guys.
Take care, guys.